We haven't been 60-40 people for probably 6 years at this point, so we're throwing darts at 60-40. A big chunk of that has moved into alternative investments, both on the income alternative side as well as the growth alternative side. So investors looking at private equity, real estate, private credit, alternative credit of all types. That's really been the norm for our clients. And what we're talking about is a more accommodative environment to really invest across the board once we get past this peak in rates. We're not there yet, so it's a little bit of the waiting game, but we're getting close.
And when you look at the expectations for the full year, you mentioned that 2 to 4 range. What data points could draw that to go closer to 2, if not 1, if apparently Vince Signorella is calling for none?
Right. I think there's 2 that we focus on most closely. One is CPI, that's obvious, but we've had some volatility in the month-to-month CPI readings. While the longer-term trend is still intact, that we're dropping, that inflation is coming down, you could get those spikes in monthly CPI, so that would be 1. And then 2 is labor. You know, the jobs market has been so impressive throughout this cycle that if we got a real disruption there, that would be nerve-wracking, because there's some of us believe that just as the Fed has tightened and we're starting to see it play out in the labor market, some companies are getting out in front of this to really start to change their hiring intentions and even reduce headcount. And so even though the Fed is working so hard to avoid causing a recession, if we stay at these rates for much longer, we may end there.
So Alex, my colleague here, Bailey, he's a young Turk. He can go out and take all kinds of equity risk. I'm thinking about the 2-year Treasury, 4.69%. What's wrong with that trade?
There's nothing wrong with a 2-year Treasury as long as you don't have anything to do in 2 years. Our view is that it's better to build now, I don't know, maybe you don't have anything to do in 2 years, but our view is it's better to build a portfolio that has a variable maturity structure to it. We favor municipals for taxable investors over treasuries, a little bit of a tactical allocation to some shorter treasuries just because short munis are so rich. But I would be in a muni portfolio much faster than I would start to build a treasury portfolio today.
You're preaching to the choir, Alex.
I was going to say, I'm bored with munis, but apparently that's where I should be putting money to work. But talking about, Alex, interesting, riskier opportunities, how are you thinking about ex-US investing?
That's where we start to get excited, only because that's the next, right? US large cap, US mega cap, Mag 7, et cetera. That's now. What's next is really our challenge that Bernstein investors look to us for advice on. And our view is next could be Europe. Next could be some part of emerging markets. I think when you look at Europe, you have to acknowledge that EPS growth there will not keep up with the US, so it's more of a valuation play. And EM, you have to be okay with taking some macro risk of China. I think that the numbers out of China have started to slowly improve, but that's a long path out. So number one, you've got to be a long-term investor. And number two, you've got to size it correctly, because even though we think it will work, it's going to have some volatility around it.
So Alex, at Bernstein Private Wealth, to what extent do your clients come to you and say, I really want exposure to alternatives, whether it's hedge funds or private equity or private credit? And if so, what do you think is a reasonable allocation to alternative investments?
Yeah, our investors have expressed both a desire to invest in alternative investments, but even in larger numbers, they want to move away from public markets. I think the experience of the last few years, 2020, COVID was really scary in public, even though we ended up in a good place. 21 was terrific, but it never felt terrific. 22 was really hard. 23 was another year where at the end of the year, you couldn't believe how much money you've made that year because it just didn't feel that way. So they're looking to get away from public market volatility, both equity and fixed income volatility, by the way. So I think some of it is absolute attraction to alternatives, but a bigger chunk is this idea of how do I get out of the publics? And so we have been investing heavily in private equity, both primaries and secondaries, really excited about fresh capital right now getting put to work in real estate. One of the things I would say across the board in longer dated alternative investments is that you don't have this big flood of other big institutional LPs applying capital. there's been some reluctance because of the 2022 public market experience and how these big LPs are trying to right size their liquid versus illiquid. So they're taking a year off, maybe two. They've definitely hit the timeout button. And so we're able to step in. Other groups like us are able to step in and acquire assets at a much lower price because it isn't as heavily trafficked.
Alex, to quickly touch on that, I cover equity capital markets and IPOs. You're talking about the private markets and some of the issues for LPs and GPs. Where do you see opportunities within the private market, given the disconnect that you're talking about?
I would first point to real estate. I think there's a number of real estate funds, big multi-billion-dollar funds that were raised 10, 12 years ago that still own assets they need to sell, whether they restructure in a continuation fund or they're looking to do off-market secondary-like transactions. I think you're going to see some significant deal flow there.
Yep.
Last year, 2023, was the lowest deal volume in commercial real estate in like 25 years.
Yep.
So we have to see the other side there.
Trying to call.
And then I think in private equity and venture capital, you're just not seeing the valuations that you had to pay 3 or 4 years ago in those private markets. You're already seeing the lack of big capital investors there bringing valuations down.